This is Tom Aspray with a Viper Report Market Wrap video for the week ending April 17th. And with a long weekend and the current market status makes next week's opening quite interesting. This is one of the reports I look at in terms of what I'm going to talk about in the video and also what I'm going to recommend to my clients. You can see this is the watch list grid designed by Jerry A, and a rundown of not only all the sector ETFs but some of the other important ones. And the relevant point here now is at the top is that the consumer staples gave a weekly buy last week. Gold shares is still all positive, but no one else is all positive. You can have positive daily on the XLK, the XLU, the QQQ, the SPY, and the SMH. We'll talk a little bit more about these when I get into the sector wrap. One thing I don't talk a lot about in these videos is the importance of the tail and the candle formation. Of course, the monthly data is the most important, and if the market does move higher from here, and of course if it makes new highs, you should be looking back. You can see that the range here, in the NYSE composite, we dropped down to the S1, at 16,929, and right now we're at 18,367. So we got below the weekly or the monthly Stark band here on that low, and that's consistent. When you see this tail and then you get another bar, is that there's a lot of demand coming in at that level. Monthly AD line's not the end of the month, so it's not really important, but you can see they're still clearly positive. If we're to get heavy selling before the end of the month, the NYSE stocks only has the potential to drop below its moving average. Seems less likely in the NYSE All. Looking at the S&P 500, this is a weekly chart also. You can see that we've had a couple of drops below the weekly Stark band. First here early in the decline, those of you who use Stark bands will realize that you get below the Stark band, it does favor sideways to a rally. We got a kind of a rally the second weekend before the sellers again took over. So 2 weeks ago we dropped well below the Stark band again here. The low here was at 58.35, I believe, and you can see that the fib support from this low in 2023, the 61.8 was at 48.91. So we've come down to that level. This is also corresponds to, the high in late 2021, early 22 before this decline. So that's a significant level. It was a significant level of resistance until early 2024, and then it became a significant level of support. So time will tell here. Well below the 20-week EMA, the fact that it's still declining, is not a good sign. Typically, if we get down into that 20-day EMA and the Stark bands, we see a sharp close higher, and then we take off to the races. That's been the case basically since the correction low in 2023. So far, obviously we were down last week, so down 80 points. So that somewhat muddies. That's a negative for the week ahead. Those of you who use stock charts, one of the things I like to do is the ability to see the price levels. So in your chart setup here, you can see that we have price labels here clicked on. So you can see what 48.35. Okay, that's and 47.86. So that 5,800 level is a key level of resistance. We need to probably get above that to confirm that the correction is over. The sentiment is still quite negative. You can have, this is the number of bulls, down to 25.4, but more importantly, the percentage of bulls minus the percentage of bears is at 31.5. So 31.5% are more investors are bearish in stocks for the next 6 months than those are bullish. Historically, that's a very low reading, and in the past has coincided with market bottoms. Of course, we continue to watch the SPY or the S&P 500 because the fact that its AD line here is still above its EMA here, slightly below its WMA, but it did not make a new high when the S&P made a new high in early February. So, if we break below these two levels of support, that'll be quite a negative sign. So far, it's holding up quite well, and but that's something to watch. You can see here's another low of the bull-bear sentiment. As for the daily outlook, let's look at the daily technical studies. This is a daily chart of the SPY, showing the whole decline from that February high. Pretty much we got a short-term traders, we're trying to scalp the market. We got a good opportunity here on Monday. SPY got up above 544, I think, and then dropped down to the 518 area on Wednesday. You can see the AD lines, are trying to turn around, but all are, majority are still below their moving averages here. So a bunch of levels of resistance. Obviously, first for the SPY, needs to get back above its moving average. It's, like a couple of, like 3 or 4 issues short at this point. But still, for a major signal, I'd like to see a move above this resistance and above that peak, which was kind of a nice fake out. Stocks only is the weakest, so we have the short-term downtrend D, longer-term downtrend C. You clear both of those, that's a good sign for the overall market. Whereas the NYSE All, you can draw a similar short-term downtrend, has strong resistance from March right up in this level. This is a weekly chart of the QQQs. Rallied and closed well above the lows from a week ago, but still 20-week EMA in blue here is declining. It's at 485.22, and of course the yearly pivot, we've been below it for a number of weeks at 482.57. So the AD line did confirm the highs early in the year, has dropped slightly below its moving average, just a handful of issues below it. But we need a good, strong, positive day of breadth in the QQQs to turn it around. No real clear trend in the RS. You can see we're in this trading range. We're below its moving average, so that is a sign that we're underperforming the S&P 500. Look at the daily chart of QQQ. Similar, couple of pushes up to this declining 20-day exponential moving average. Currently, it's at 458.21. So clearly resistance right above at this high here, and then the pivot's at 479.51 on a monthly basis. So AD line, is trying to bottom. I mean, there's no real divergence, just a little level of support here, and of course last week's low. A daily close below that would sort of put the donuts down on a further decline. You can see we just hit the declining moving average last week, and if we look at the relative performance on a daily basis, you can see it's also range bound. A strong close over these peaks here would be a sign that the QQQ is starting to lead the S&P, which would be consistent with a further rally. The high-low analysis, is still, basically negative, but it was a good sign that the number of new lows didn't show any pickup. So we see a move back above 200 here. That'll be consistent with another wave of selling, and maybe a drop back to these stark bands in 17,319 area in the NYSE. Conversely, to see something positive, you'd like to see a push in the new highs, above that 80 to 100 level. these readings are consistent with those in the NYS or the Nasdaq Composite. You know, so still below the 20-day, still negative. Typically before you see a major uptrend, you need to see that the 20-day starts to rise. So 20 days out, last week's numbers are going to start dropping out. In the next before the end of the month. So that'll be interesting. But see very low, 136. New lows on Friday. A big change from 1750. So we want to see this stay low and hopefully see the number of at Nasdaq new highs, which was at 39 on Friday, get back above 100. The VIX VXN analysis, is positive. We had a spike high here, and subsequently a VIX spike buy signal, and this is still, it could turn back higher, but it looks like it's back in a downtrend mode. You can see there's some support for these two lows. The support in the VIX has already been broken. Put call ratios a couple weeks ago spiked, above 120 in the total and above 1.6 in the index. So clearly, there was enough bearishness at the market lows to create a bottom. So we'd like to see them continue to drop down below the 1 level, which would mean that now the put and call buying are in equilibrium. In terms of growth versus value, the ratio turned back down. Looking at the chart, you can make a case that was the rebound, and that value is going to continue to outperform growth. So you can see we just tested this former support. Clearly a drop, back below the low we made a week or so ago will reinforce leadership in value over growth. MACD analysis is negative, shows no real signs yet of a bottom. Looking at the ETF weekly scan, I'll try to hit some of the high spots. Subscribers can see this in more detail. Basically only 19.6 of the ETFs closed above the quarterly pivots, up from 13%, but still pretty low. Lots of room for improvement. 3 positive weekly S, as I mentioned before, XLP, VDC, which is the Vanguard equivalent of XLP, and EMLC. There was a negative weekly in IHF, which is a health ETF. So, growth, 0 above the pivots, and positive, weekly S. 50% are positive, unchanged from last week. So, these XLK, IWF, these growth names are still in their daily. So, are they going to flip back to positive 3-day? That's the question. So, value doesn't look, that much more robust either. And if you look at the, the analysis, negative across the board on the long leveraged ETF, positive across the board on the short ETFs. So you can see this is a chart of the SPXS, that's the triple short. Let's look at a live version of that. You can see that reversal bar as SPXS was making a high above 1067, flipped down and was stopped out here, and now gave a negative signal last week on Tuesday, and but there's no corresponding positive signal on the long triple long. Its last negative signal here on March 28th is still intact. We're below the 20-day EMA. The stop is pushed down on this, so it could turn at any stage. But I find the best signals are when the daily and the 260-minute are in agreement. That's not the case at this point. The sector readings for the ETFs, not a lot positive. You know, you can see that energy had a really good week, 8.3, as is the industrials. XLY has continued to improve, as is XLP, went from 41.7 to 58. Healthcare is still low. XLF and XLK at 0. A slight improvement in XLC and a big improvement in XLU, and back to 83. It's the only one that's well, other than XLP, that's above 50. There were some interesting developments in the RS analysis in our sector report. You can see, as I said, it was a good week for energy, but you know, WMB is about the only one that new signals turned up from back to the lows. Materials, is this pattern of lower lows and not lower highs, so we'll be watching that. Industrials do look much better, even though there aren't a lot of new positive signals. ADP and DE have daily, and only IMF, or LMT rather, has positive across the board. Consumer discretionary starting to see a little more green, 33.3%. Could be a bottom formation here. We're back below the moving average. So if it could move back above its moving average, that would suggest that the beaten down consumer discretionary sector is finally ready to turn. Elon Musk will be happy since Tesla is part of that. So we're watching this for some more 3-day positive signals. Staples continues to look strong. Healthcare still is holding support, but not a lot of. Eli Lilly had good news, and as did Abbott, but a lot of red in healthcare, even more so in financials, though the RS analysis has flipped back to positive. Technology still in a downtrend here. Broadcom here and Apple have some green, as does Intuit. And communication services, we our longer term buy levels were hit there last week. It closed off, so Netflix, of course, strong earnings, and it's green across the board. So we'll have to be watching the other ones. Utilities, a strong chart here, as does the real estate, and lots of green in both categories. So once again, looking at the AEP and SRE, which have just flipped to 3-day ETFs, as is OVICI and American Tower AMT, as well as DLR. In each ETF report, I used to take a look at the intraday charts of the Qs as well as the SPY. They trade pretty well technically, using the 60-minute or the 78-minute, which is like 5 bars a day. So here's what I'm looking for this week. You can see that we have resistance here in the RS, this blue line. A move above that would be a good sign. OBV still in a downtrend, lower lows, lower highs. I think I mentioned in one of the recent reports that interesting feature, if you want to get next week's pivots based on a weekly pivot, if you put 5 extra bars in and hit update, you'll now see it calculates the pivots. That's, it's, they're not going to change for the week because the last trading day here. So, 448.97 is the pivot, 460.18 and 432.89. So 432.89, right down in here into a good support area. So if you tend to be bullish and you saw some improvement here, that would be the the level to be buying at. And conversely, if we get a rally up to 460, the R1, without a lot of positive technicals, that'd be a possible rally to fade. Hope some of you saw last week's article in on Forbes.com has more chaos stalled the market. After a rally on Monday and Tuesday that failed right where it should have failed, there were signs in the overnight news about NVIDIA that favored the downside. We certainly got it on Wednesday. The market has held up better since then. So I hope you get a chance to read it. You can look at all my charts or articles on Forbes. If you search Forbes : Tom Aspray, you can see this is what we're technically looking at. And as we see now, we have the AD line for the QQQs has turned lower, still the same range there. And if you look at the NYSE composite, you can see that the McClellan oscillator just hit this downtrend here and turned down. Still no bottom in the NYSE all AD line. Well, please send me your feedback, questions to tom@viperreport.com. And if you want a copy of the Viper ETF, where I look at the 4 sectors that I really like on a longer term basis, drop us a line and we'll send you one. Thank you very much.